Actually, this is a derivative talk from talk to the IASB, the International Auditing and Assurance Standards Board, which I made with a guy from KPMG. Now, what do you think, before we start this, what do you think I would like to talk to the PCOB, I would like to tell the PCOB?
That they should use more analytical type techniques.
Absolutely. That they have to think carefully about the usage of analytics and use more of it. Now, I'm going to bring you a couple of dilemmas up that motivate this thinking. My first dilemma is the following. Jamie here gets hired by PwC, and he's a hotshot data analyst. And he goes and does a clustering techniques, and he finds an error that's material. So what does Jamie do? Goes talk to management, say, I found this, what are you going to do about it? So management fixes it. Is that a good story or a bad story? Everyone is saying good. Kristen, you think this is a good story?
Yeah.
Why?
Well, you just fix it versus figuring out what the underlying problem is.
Yeah.
In the system.
Let's assume they even fix the underlying problem. What is the chance that last year that they had the same problem and they didn't detect it? Pretty high, isn't it? System problem that needs to be fixed. So what's the consequence? You have to restate. And you as an auditor didn't catch it. Maybe the year before had it too. Maybe the year before had it too. So this is a big dilemma, isn't it? Because that means costs you a lot of money. They are not going to pay twice for the audit as the firm. Loss of reputation. The PCOB could get very mad at you. So you are doing the right thing, doing a better audit, improving your quality, and you're being punished for it. That's a big problem. Second problem is the rules of auditing don't seem to forbid you to do analytics. So why change any rules? So why change the rules?
Well, they don't forbid you from using analytical techniques, but they don't encourage you to either.
And why should they encourage you?
Because they'll force companies to do this, even though there might be, in the situation you describe, some sort of negative situation that arises from it.
Okay. What I usually say about this, and I like most things, you're not totally sure about it, but what I usually say about this is there is an economics of an audit, and the audit is budgeted for XYZ to do this work. The standards force you to do sampling and et cetera, in general, not always. Okay? So you have to do your regular work and then do this. And now you're going to see, so I think I motivated this enough, now you're going to see see a little bit more about this. So I'm going to talk a little bit about the car lab, which you already know. Do you know who these are? None of you is in it. Is any one of you in here? No. Kirsten, you are here, correct? Or this is an old one? No, you're not here. Oh, who is this? Ben, are you here?
Yes, next to the J, just the face between Edward.
Yeah?
Yeah.
I got it very well. I always joke when I show this, I say, we have minorities at the car lab. You can see that? And everyone think, and I say, we have 4 Americans. Let's see Americans here. Barbara? Who is this? I can't see.
Andrea.
Paul? Sherry. So anyway, that's the little joke I did there. Okay, and I talked about the digital library. Everyone knows about the digital library, correct? By the way, if you don't know enough auditing and you want to learn more, you can get a textbook or you can get Helen. The digital library have Helen's entire audit course taped.
Yes.
So you can go in there and have a look. Ask this guy, he'll show you exactly where it is. Okay, and it's sometimes a little bit less painful than do it. Okay, so this is talking about audit data analytics, and this is actually a slide prepared by this guy called Bob Dorr. And Bob Dorr is the chairman of the Audit Analytics subcommittee of the IASB. I mentioned this once, let me just write it out here. This is the IAASB, International Auditing and Assurance Standards Board. And this is basically a conglomeration of organizations related to internationally setting standards. The PCOB is a member of the IASB, but doesn't follow the IASB rules. Some countries follow IASB, other countries don't follow IASB. Actually, I'm not totally sure PCOB is a member of it, is it?
Not sure.
Must be. Maybe not. And actually what Bob Dorr was saying is that the standards tell you to do this analytic here, do not this side, do analytic here, do analytic here. Okay? And what he's saying is that audit data analytics are evidence for every stages of the audit. That was his argument. Now we go to the core of this story. And we have several illustrations here that raise the same questions I was raising before, but maybe a little bit deeper. Okay, a few of you haven't taken audit, so let me talk about the 3-way match. For every invoice, shipping documents, and sales order received from customers, compare the invoice customer quantity and unit price to the quantity shipped per shipping document and the quantity and unit price reflected in the sales order received from the customer. So you're matching the sales order with what you did. Objective: obtain audit evidence over the existence and accuracy of revenues, the revenue test. AS 115 paragraph 11. It tells you to do. The AS are the IASB standards. Prior year approach. Test of internal controls over the revenue process, substantive analytical procedures, and test of details and sample. Now comes the interesting issue here. This is actually an example from KPMG. The guy working with me was Phil McCullough, at that time head of development at KPMG. And he says, you did a three-way match on 725,000 transactions. And you found no differences in 691,000, 95% of the transactions. Is this good or bad? Pretty good. Pretty good. You could say 5%, 4.7% were wrong. You could say 95.7 were right. Let's go to the next thing. And you found differences in quantity shipped in 16,700, and you found pricing differences in 17,300. So total here is 34,000. So you finish up with a 4.7 difference rate. Now, the materiality threshold is 1 million euros, and the amount here is 3 million, and here is 2 million. So are these material errors? Yes, no, maybe. The total value of these differences is material. But this doesn't mean that there are material differences here. What this means is that some items shipped partially. What does that mean? Is you had an order for 10,000, you only had 7,000 available, so you ship them, and you will ship the 3,000 later. Maybe it's already in that sample as a separate part. Does this mean it's wrong? No, this is normal operations. What does pricing difference here? The table of pricing says XYZ, but you have to deal with the client that you charge less. Or you have circumstances that you charge more. For example, urgent order that you need to spend more money to send. Now, this is interesting thing. The first thing is what we call full population test. This is a test that you're exerting over the entire population. Now, what is the traditional way to verify a three-way match? You pull a judgmental sample. What does that mean? You pull 50 or 20, or if you are very generous, 70. Now, what is the probability? How many transactions you're going to find with a difference? 5%. 5% of 20 is 1. 5% of 50 is 2.5. So what are you supposed to do when you find? You won't find 2.5. You find it 2 or 3. So what are you going to do next? What you're supposed to do is follow up on the variances that you find and understand what they are. So, in theory, here, you would have to follow up on 34,000 transactions instead of following up on 2. Are you stupid or what? You're not going to follow up on 34,000 transactions. It's going to spend the rest of your life there. You'll be fired from the firm, running over your budget by a factor of 10. So we do have a problem here, don't we? Yes or no? Okay, so if you had those 2 transactions to follow up, what would you find out? You'd find out likely that those 2 transactions are maybe one instance of quantity that was shipped later, one instance of some price agreement. Now, you are not going to follow the laws, the rules basically tell you should follow the variances you find. So what you're going to finish up, taking a judgmental sample here and staying with them, because anything else you do will put you in a big bind. So this is actually the bind. This is the bind where it's find material errors. This is the exceptional exceptions problem that Professor Hussein Issa did as his dissertation. Okay, and what Hussein argued in that, and actually Hussein wasn't the first. The first one was Young Bum Kim. You met him, correct? You didn't meet Young Bum? No, he came by here. I thought you saw him. Young Bum Kim was one of our PhD students. He is now at Mammoth College, I think. No, he is Ramapo. You guys know him? He actually did a dissertation whereby he pulled samples based on criteria, and then he did a Venn diagram-like type of thing, whereby he said this is duplicate transaction, this is manual transaction, and he had 3 criteria. And he says, here you find one error, here you find one error on these transactions. Here you find one. But however, if these 2 things happen, it's more likely than if one happens to be a bad transaction. This convergence here is the worst. So he just basically gave a weight of 1, and if you had 3 events, they were more likely than 2. Now, the entire population was much larger, and if you had none of these, the likelihood this were these guys here. And then Hussein did a little bit better than that. What he did a behavior experiment, and he gave weights to these things based on some kind of behavior criteria he came up. And we call this the exceptional exception problem. And that was Hussein who gave this name. It's a cute name, correct? But one of the radar projects is the exception project, but we don't call it that because the moment you hear the word exception, the auditor's eyes get red and they start biting. So you don't want to call it an exception. So we call them, I think, anomalies or something like that. I'll show you in a second what we call them. Okay, but the idea is the following, and let it kind of go to the bottom line of the story. I just gave you the tasting of the story. The bottom line of the story is that by using computers and testing every element of the population, you are gathering evidence, although the standards don't let you call that evidence. We call this full population testing. And you need different criteria to deal with full population testing. By the way, at the PCOB, they didn't object very much to my story. They thought this was a good argument. Okay, then there is this whole thing. Actually, I didn't ask this question, it was Phil who asked this. And for a little while, it took me a while to understand what he was asking. Asking was, is a 3-way match procedure data analytics or is it automation? Data analytics are one of the tests that you can perform at the beginning of the audit to establish the risk. Automation is something else that is not discussed. My answer to this is full population testing. And listen to this, and by the way, this is not my argument, this is Mike Leonardson from E&Y's argument. He said, by doing this, you are not detecting errors only. You are actually saying that 95% of the population is okay because you just tested it. And then to what I add the argument is that if you know the nature of this population better, you can put not 2 filters, one for price, one for quantity, but 20 filters there of things that you know will have. The more you go to the entire population, less you're going to have a residual to examine. And you can do that now because you do full population testing with the computers. Now, I'll call your attention to something else that's obvious, but unless unless you formulate it, you never thought of this, is what an audit procedure is not worth performing if your cost of performing the audit is higher than the loss that you are going to have. Correct? Why are you going to test something that is expensive? You're going to have a definite cost as opposed to the cost you already incurred. So our audit procedure, there is a trade-off between the value of what a procedure can find and the cost of performing that procedure. And that's the thing that has been forgotten in the standards, is that computers came into being, changed the balance of cost versus revenue, and hasn't been recognized. Actually, what we showed before is a procedure whereby you do full population testing at a reasonably low cost and gives you evidence not of things being wrong, but a lot of things being right. Do you understand the nuance of this? And actually, the standards don't give any claim, any credit to the full population testing that's being done. And then the next thing, this is basically to put some doubt into those four circles that I showed at the beginning, the risk assessment, et cetera, processing. Is risk assessment relevant beyond determining to execute the procedure? Meaning, does the three-way match gives you any idea of risk? Is this a risk assessment or a substantive procedure, or both? And the answer is both, correct? And so it's confusing those four stages of the audit that typically the standards give. And then the next question is, what impact the ability to having such a precise, from 1 second to the other, instead of knowing what happened to 50 transactions, you know what happened to large percentage of them, 95% of the 600,000. And of course, the standards, I think in this case, do inhibit, do forbid the standards do forbid doing analytics in this case. And why does it produce audit evidence? Obviously produce audit evidence, examine 600,000 instead of examining 50. And then the next thing is, how does the knowledge gained for performing procedure in year 1 affect year 2? You know something about the controls, but you're not totally sure the controls are there. Now, how about inverting this? How does the knowledge gained for performing procedure in year 2 affect year 1? How does that?
Well, if you were not using audit analytics in the previous year, you may have run a test
Good.
that you not found any.
This question, correct? And then stop here for that example. Now this is Yoon's dissertation. Remember Yoon? Okay, what did Yoon do? She has a sample of a large retailer that you all know who it is, with only sales, that's all what she has, for 2,000 outlets. And what did she do? She basically has 2 studies. I will try to get her here to talk about it to you. But she did, basically she's trying to do predictive analytics, but from peer information. So she's looking at certain outlets and trying to predict what the other outlets are going to do. And she's using some exogenous data from where? Time series extrapolation and cross-section analytics can be used to predict results. Substantive analytical procedures. Paragraph. If trajectories are fall within acceptable variance, assess whether further year-end procedures are necessary. So what did Phil wanted to do at KPMG? He wanted to compare his predictions for each store with the results that management said, the assertions of management, and if the difference is too small, you would just ignore and say we don't need to audit this because the results are what we expect it to be. And if the difference is very big, they would say this store we really need to go and have a look, either some economic problem or a bad prediction. So what is a big difference? What is a small difference? Okay, you want a dissertation? You have a dissertation here. Idea for a dissertation. Remember, we are talking about inheritance risk, control risk, etc., etc. Idea for a dissertation. Try to figure out if you can mathematically come up with, if you take a control risk of 5%, what is the acceptable variance in the store that you could make? Create a mathematical way to relate one to the other. It's an analytical dissertation. A dissertation for Carrie. Carrie is our mathematician in the group. You know who Carrie is? Professor Lee, Carrie Lee. Very productive. She just had a baby, beginning of this year. Number 3. So she's still productive, not only that way. But she was studying at Northwestern and did the analytic audit dissertation. She's very smart. And so this is kind of interesting question. What is the allowable? What is the different? I have been talking about this idea of acceptable variance from a prediction in all my continuous auditing work. In addition to traditional procedure, predictor increase performing the audit, and this is the paper. Big data as audit evidence, utilizing weather, geolocation, and other indicators across outlets of a major retailer. So what did Yoon did? Is a completed dissertation. What did she do? She had 8 points of data of sale and tried to develop a methodology to predict values. And she's doing actually something different with me. Objective, predict revenue at the store level, approximately 2,000 stores for a publicly held retail company using internal company data and non-traditional weather. So she forecasting daily store level sales. And one of the things that Alex and you did here is that they kind of looked at, does daily predictions are better than monthly prediction, are that better than yearly prediction, or quarterly prediction in this case. Okay, so that's what they were looking at. And so they used a multivariate regression model with and without the P star indicator and weather indicators, and then they basically included the weather. Okay, so this is what they got. And what they did is they clustered. They used clustering to put stores that were similar behavior together. And what we expected is that these clusters be mainly geographic. And each color is a different cluster. And this is a Tableau picture. Tableau is a graphic package. But if you notice, they are somewhat geographical. But they are not really that geographical. Look at this. This blue is typically Florida, correct? But you have it here in Texas, you have it here in California, and even you have one in Wyoming. And let's look at let's say pink. Pink is all over the map, some in Florida, some here in Texas, etc., etc. Then this orange is mainly Northwest. But you also have it here and you have it here. It's cold. Now this particular retailer is very sensitive to weather. So what a bigger determinant than the tradition of the story was the weather. And the questions that were asked. And the first question is this a form of data analytics? I just wanted to read, I realized I didn't go this. Expectation derived from a store level disaggregated data are more accurate than the ones from entity level aggregated data. So it's better predict by store than predict entire company. I said it, I correct myself. I said it by day, month, and year. I actually, what I meant, what they did aggregation was per store as opposed to per company. We actually have another piece of work we did that is actually by timing, which is the continuity equation. Peer stores have predictive power sales. So this store sold, if it's in the right cluster, predicts that. Data not traditional uses substantive analytical procedures. Social media, where they do this, often effective predictive state. Just telling you what we are doing now with Tune. We are doing the same thing, but not exactly the same thing. We are dividing the country in these clusters that we have. Choose one store that is most representative of that cluster and use it to predict the other stores in the cluster. And we have 8 periods of data. So it's 4 quarters and 4 quarters. You are normalizing for seasonality, and then we are predicting. And it's actually working quite well. Now, what does this mean? The auditor will exclude the companies that are the quote-unquote the normal company, and then use their pattern of sales to predict the sales on the other companies on the cluster. If the result is very close, you don't audit. And it's kind of coming out quite good. Now the questions we have here are very similar to the questions we had before. Are predictive analytics relevant to the audit data analytics? Yes, no, maybe. If you say no, you fail this course. Are predictive analytics risk assessment procedure, a substantive procedure, or both? Clearly both. What procedures are necessary to validate non-traditional? Now this is very interesting. Can I just stop and ask you this question? Guys, don't, I was just joking that you're going to fail the course. I have the following question for you. Things like social data and social media data and weather data, is this audit evidence?
If we need to combine with the internal.
I think you're already corrupted by us. Yeah. You know, Dacier Moon did a dissertation, and he was looking at what we call CRMA, continuous monitoring and assessment. And he actually picked up 2 instances whereby social media would be a good proxy for sales, or at least effect of social media. But the question here is, what procedures are necessary to validate non-traditional data?
verifiable source.
Okay, verifiable source. So I want to ask you the different question. When you get data for doing audit review within the company, do you need to verify if this data is valid? Absolutely. You need to make very sure that the data that was extracted for you is valid data. Okay, and hasn't been filtered out for something. You have a branch that is called 9999, and that's where you put all your fraud. When you pull it without the 9999. So you need some validation. And by the way, if you do any empirical research and your sample reduces from the population, you're going to have to explain why you took this out and you took that out and you took that out. Same kind of story. But you have that risk. So the data extraction process needs to be validated. Okay, now the problem of internal tampering with exogenous data is very small. Okay, because you are not going to go there and affect millions of weather manipulations, weather measurements. It's independently collected. So in one sense, external data is more valid than internal data in principle. But in the other sense, it might not be so relevant because it's not directly out of your company. So that's the question to that. And of course, this is the core question here, is it okay when your prediction and your assertions are very close to not test them anymore, say accept it and this is okay? And of course, that's the core questions. And then there's the other question here is, should there be guidance of an acceptable level of variance? And that's the question I ask you. Is it one standard deviation? Is it two standard deviation? What is the acceptable level? And then, okay, now finish up this is actually, they told me to pull this out. I had a whole slide on this idea of experimentation period, but they let me leave the questions in. They just were trying to, I don't know what they, but we worked with a board member, and she was the chair of the session, and she told me to take the slide out. But what is this idea here? Should there be an experimentation period to create guidance for predictive analytics? What am I suggesting here?
Well, since you just came up, for example, with the weather data example, it may just be that in this 1 year it happened to work out like this. So I think what you might be getting at here is that you might want to extend this over a longer period of time to make sure that the predictive analytics.
Okay, so that's kind of time series model validation, correct? That's one story. What I'm basically saying there, and I said that to the ISB too, is that they should create a thing like they did with XPRL, an experimentation period for the standard setters to understand that this is a reasonable thing, and for us to know that our methodologies are good enough. And so, but that's really, really difficult for a standard setter to think. Now, think about this a little bit deeper on this. I actually now think that not only there should be an experimentation period, but there should be two sets of standards at the same time. If you are doing analytics, you fall under one set of standards. If you're not doing analytics, stay with the old stuff. But don't take advantage of the releases that you get from using analytics for the other. Do you understand what I'm saying? It might be a little bit complicated here. Well, this is actually, I was only thinking about the experimentation period when I went to the PCOB, and when I came back, I realized a little bit better the environment that they had, and I thought that would be better. So the idea would be that you volunteer a set of firms to be audited using analytics. And you need to engage the audit firm, let's say PwC. You need to engage a client, say you are going to be a guinea pig here. You need to engage an independent observer that knows some analytics. Of course, it's Rutgers. Who else? Correct? Or, of course, could be the PCOB themselves, but I think they really would rather observe this. And what they should do is do tens of audits, maybe deviate a little bit of the resources from inspections, if they don't have the resources, to have inspectors observe this process and in the fly develop what would be the standards of doing this. Because I think this is different enough. You know, I had students here in the past saying, this was really about FASB rules, but same thing at PCOB rules, is can you change the tires of a car while it's moving? Can you? You say yes?
Yeah, there's a video online where they like tilt it up on the side.
Yeah. That's what the students showed me immediately. I said this next, he sends me an email with this URL, and they move the car like this, and this guy grabs over the window, takes the tire off, puts a new tire in. But it's difficult to run standards and.
I just have a question with this whole experimentation. Would it be disclosed to the public that these audits were experiment? That's the only problem I can foresee with that.
No one asked me this question before. What do you think? I would love to know an answer to that.
I just think that you probably wouldn't want to disclose to the public because that would affect
The confidence on
the
the.
confidence in the financial reporting and the audit quality of those firms would be less likely to volunteer if it's going to be disclosed that they were guinea pigs. But then if the public knows that the PCOB is doing these experimental audits, they're probably going to want that information.
How about the opposite? How about the opposite is you do some experiments in auditing with big data and whatever. What is the message about the ones that are not doing it? Very good question. I have to write this down. But it's a very interesting question, correct? What do you think would be the message? Would the message be the negative or the positive? I just don't know if in this country you can do this in secrecy.
That's what I mean, people would demand to know, but I think initially anything in the trial period is going to.
Well, there is another approach. The other approach is you do both. The companies volunteer to do the traditional audit, and they are willing to do an extra step for experimentation purposes under guise of research. Maybe you can prize them from promising not to inspect it for that audit. That's they could do that. So, third illustration, clustering. Multidimensional clustering is a powerful tool to detect groups of similar events and identify outliers. Can be used in most sets of data examination procedure, looks for anomalous clusters. Let me just show you. This is Sudap's dissertation. And basically it's multidimensional clustering, and you have many variables, and you kind of find things that behave similar. And you're looking for two types of things. One type of thing that you're looking for is an entire cluster that is anomalous. For example, Sudapart worked with an insurance company, and in this insurance company, there was a cluster of insurance paid 7 to 10 years after the death of the insuree. And that was very difficult to explain. When we first asked the company said those were situations where the inheritors were fighting in court. So I went and asked Professor Soled here, and he said, oh, this doesn't happen that often. And when it happens, it's resolved in 2 or 3 years. It's a fast lawsuit. So we actually had a field, and the field was number of the checking account that the thing was deposited, the money was deposited. And then we found that there were 12 of them deposited to the same account. So we are pretty sure that was a collusion. Collusion where basically, you know, this is very interesting. The insurance companies don't know who their insurees are, who is insured. Did you know that? If a company large like AT&T, for example, gets insured by MetLife, just imagining some names, okay? The contract is on the basis of how many employees AT&T has. And the insurer doesn't have the names of the employees. And so I bet you that what could have happened, as you know, knows what happened, is that there are these databases of people that died. So someone had access to the employees, and you compare the employees that died with the claims. And if there was no claim, they created a claim. Okay, it's a kind of possible and likely, actually, as an issue. It's not that big of, it's a collusion scheme. Now, so that's the first thing. Turns out we don't know what happened there. It went to the legal department and it disappeared. You know, once things go in legal department, you never know what happened. So we can't work with that people anymore, because if we don't know the outcome of our research, how can we work? Correct? Now, the other thing that you're looking in clustering is the distance of the particular observation from the geometrical center of the cluster. There is thing called Vasarhelyi distance, or there is geometric distance. And you basically calculate this distance. And the farther you are from the center of the cluster, more likely, is our opinion, this hasn't been proven, that this is an outlier. Okay? And so these are the two things. A group that's a group that is not explainable logically, and geometric distance from. And what we have been talking about these days is about the suspicion function. And remember, I told you about Young-Baum Kim's dissertation, and Young-Baum Kim's dissertation basically gave a weight of 1 to having a certain parameter. Was a duplicate or was except a manual entry. And so here the parameters in Young-Baum were 1. And then Hussein had a number here relating to this parameter. And so we're just thinking that we'll add a variable here that will be the distance, Vasarhelyi distance, or geometric distance. And of course, this needs all to be proven and etc. But I want you to kind of look at this and remember this, because this idea of a suspicion function, most likely normalized between 0 and 1, is actually very important in audit analytics. And what we think that we are doing more and more is creating unorthodox variables that will explain better the suspicion of a particular item. So you look at the characteristics of this particular item, and you put a value in here, and then the distance to the core would be another variable. And of course, this is a dissertation to be written. When Sudhapa did her dissertation, she just kind of showed clustering and showed that this can be an audit tool. It actually was quite successful. The people at Hewlett Packard got very interested and applied for a patent on this. We the way we work with the car lab, we don't patent anything. We let the people that we work with patent it, and if they want to make any money out of it, we just write papers. And our agreement with most companies is, you let us write papers, we let you look at it to see if we didn't say anything bad from your company. You can co-author if you want to, and most of the time they accept to co-author and they're very happy to co-author. But sometimes maybe they won't want to do that. So that's the way we actually do that. Okay, and this is, there is another dissertation just for your interest. Paul Byrne's dissertation, who finished this year, he actually did what we call a super app in clustering. And what is a super app? Is an app with statistical knowledge. So, for example, this guy, Bill Gale from Bell Labs, wrote this paper about Rex. Rex was a regression expert. And basically you run regressions, and then the result of the regression has a little expert system that interprets it for you. And we think that auditors are not going to be good enough in statistics to pick up all the nuances of clustering or factor analysis, etc. So we need that. So Paul did that, did a little regression expert, he did a clustering expert, which was Paul's dissertation. And these questions are also cluster related, basically the same questions. I don't think that is too much of an argument, at least I never heard of someone saying that if you run clustering and find a big outlier, that's probably a real outlier. There is no argument about the idea of using clustering. Now, let me just say something about clustering. It's very difficult to do clustering with very large populations. What you need to do is, particularly because a lot of the clustering is done also by visualization. And so in general, the stuff we have done which was with reasonably small populations. Now you can pre-process it and create groups to evaluate. So what audit evidence does clustering create in any full population that has tight clustering versus outliers to the cluster? Meaning, what's the value of outliers? Is clustering a risk assessment procedure, substantive procedure, or both? What are you, no, and now we are going into the audit standards question. What follow-up outliers is necessary? Is there a materiality issue? If you do clustering, can you reduce other substantive tests? Same question we asked before. Should there be a guidance of acceptable variance? If auditors or others are developing application for use in the audit, what quality control should be performed to verify the application is fit to the purpose, technically sound, and etc. Remember the following. When you are doing analytics, you are doing procedures that didn't exist before. There is not 100 years of experience on you should do it this way. So there is a lot of validation questions that arise. Same thing about the experimental period. Okay, so I'm done with the 3 illustrations. I just want to call your attention, and it's a little bit redundant for you, about the 3 projects we have in Radar. Okay, does everyone know what Radar is? Do you guys know what Radar is? Last year, we started this project called Rutgers AICPA Data Analytics Research Initiative. And it's a project supported by the Big 4 plus the next Big 4, the American Institute and the Canadian Institute. And the idea of this project is 2 things. One thing, develop analytics to improve the audit. The other idea is selling it to the PCOB. If you were wondering why I was at the PCOB Institute, is because we tried different ways to contact the PCOB, and they seem to be interested. They actually are doing quite a lot on looking at analytics. Although the IASP had an exposure draft. I'm going to send you the document actually. And we together, with Helen and etc. are putting. Is any one of you participating on this? Are you participating on this? On the response to the IASB? No, you might. And so the IASB put out an exposure, a document to discuss analytics. And they have an advisory board. I'm in the advisory board, so if you have any ideas, please let me know. So as I said, Rutgers, AICPA, CPA, and the allied firm started officially in 2016, and we have now 3 projects going on. One, Professor No is running the project, and this is, we call it exception. We call it MADS actually, because auditors, when they see the word exception, they get very angry. And so you don't want to call it, we call it now notable items. And then process mining, you will hear about it in a second. And then visualization, not a way to show the results to the client, but as a way to interpret the results. So this is actually the MADS project. I always have to look up what MADS means. Multidimensional Audit Data Selection. Okay, and you will understand this in a second what this means. So this is like the population that I showed the KPMG thing, the 600,000 transactions. Entire transaction data in entire population. Auditor judgment-based filters. So your filters here were price and quantity. Remember that? So out of the price and the quantity, you find the notable items. We used to call it exceptions, but that doesn't work. The notable items are the 30,000 items we found before in that example. And then you have to come up with criteria to find what are the real exceptions that are worth examining based on a mixed set of criteria. And that's basically it. Exceptions, and then we have this terminology, prioritize exceptions. So these are the 30,000 selected. Actually, these are the 30,000. These are additional filters that you put on this, and these are the ones that you want to examine. Now, this is out of the standards. You don't have the right to do this today. We need to. So I think I showed you reasonably strong arguments that the standards actually are a problem in the audit of large data in the modern audit. So this is the MADS project. We have some data and we are doing that. Okay, now this is the other one, which is actually what I find the most interesting. This is Tiffany's dissertation, Abdul Rahman's likely dissertation. But this is a very, very interesting segue, or very interesting potential to change the audit completely. You guys are too young to know this, but in the old days when you did an audit, you picked up your judgmental sampling of 50 and went to the file cabinet and picked up the document. And the document would have in its corner a routing. And what does that mean? Is that I received the document, I sign it. I pass it to the next line, he signs it and dates it. And so you know the time and the person that executed the procedure. And what you would do at that time is see if the right people signed it and if there was any anomaly on the timing. This is actually same kind of thing, but very automated in the future. What happened? What is this? This is actually Mieke Jen's dissertation. We got it in the accounting review last year, so now it's kind of more reputable than it was before. We got it also in IJIS, so we have an IS article and etc. And this is a technology developed in Holland by a guy called Van der Als. And there is a whole group working on this, but this is not for auditing. This is process engineering. This is understanding processes in modern companies. And so that it occurred, I think, for Mieke originally, that this could be used in auditing. And basically audit ERPs like SAP and Oracle create logs. And you can have something very similar to the routing sheets, but you have to extract tables, you have to organize them. It's a little bit intricate. But what you can do is understand what happened to a transaction. Which is very similar to what you are trying to do looking at the routing on a manual document. Did you ever do a manual document that you look at the routing, Kristen? It's past, isn't it? They don't do this anymore, meaning it's gone with...
We would check signatures.
Huh?
We would check signatures.
Check signature, you did?
Yeah, but there was no like date. I mean, maybe there'd be date, but more
Interesting.
like journal entry testing and see if someone.
Yeah, who endorsed it? But you can do that with journal entries too, this automated process. Yeah. And so actually when I heard of this and when we wrote the accounting review article, we came to this idea from industrial engineering that 5, 6 types of transactions. Type of transactions means what? A routing transaction went like this, then like this, and here. Would explain 70 to 90% of all the variance. And it happened. 5 or 6 transactions explain most of the variance. What we were not aware is that there were 960 variants. Variants are paths that these things can follow. And my first reaction was, how is it possible? We have 6 stations, the permutation of 6 doesn't give you 900, or give you very close to that. Okay, 6, 5, 9. Permutation, the repetition. 6 multiplied by 6. Yeah, it doesn't give a lot of variance. So, that was the question that actually Tiffany is working on. And what Tiffany did, she's the one that identified there are 960 variants. And she went hand one by one looking at what those variants were. And now that's where we are trying to understand this. This is a step ahead. This is if we can do this right, this is an accounting review article that we are planning. And actually, I don't have the slides here, but let me just tell you for a second. We're probably going to cover this in class anyway. She came out with the classification of acceptable transactions, types of the paths. Those are the 5, 6 major paths, and then non-acceptable. And I told her to take the name non-acceptable because she doesn't know, and we call it notable paths. And now one of the chapters of her dissertation is trying to develop a method to decide how you use that path in a suspicion function. So I would think, I don't know this, please don't take too much serious. I would think that she'll find some paths that are totally unacceptable. No signatures, or same person signing everything. And then you're going to find a lot of paths that are kind of in the middle there. And then the question is, how do you use that information? Now, is this strong audit evidence, or this is weak audit evidence.
I'd say that it's pretty strong.
Yeah, that's what I think. I think it's very strong. I think this, if this can be automated reasonably well and the technology can be resolved, this is much stronger than anything we do in auditing. Because you know exactly what happened to the transaction. Exactly. And so I think this would be one of these items here that would be very strong. Remember, this is ex post facto, suspicion. This is a duplicate. You don't know anything. But here you know that no one signed this thing. So that's, I think, is very powerful type of thing. Now, we had very much difficulty convincing the people of radar to work on radar for us to do a project on visualization. And the difficulty was they think, well, we know how to do Tableau, so why do you need to work on it? But what we were trying to convince them to think about what we call exploratory data analysis. By the way, you better write this down, take a note for this. EDA. Exploratory data analysis, confirmatory data analysis. This is Ji Lu's dissertation. She is actually running this project. She is in Albany. And what she is doing, what the idea here is using visualization to interpret data in models that you can't do just analytically. Like that, I say that there is a part of the audit which is the scanning of data. And you always talk about scanning of data as a form of substantive evidence. And what does that mean? Is looking at data and finding something. Now, then you are comparing what you can do visually with your mind with what can be done by a computer. And if you have followed market studies from the past, meaning much before you're born, what people used to do, this is actually a generic research methodology. What you used to do is you look at the literature, come up with your ideas, and formulate hypotheses. And you formulate those hypotheses as tight as you can, because you would have to collect data, and collecting data is very, very expensive for you. I had my PhD student doing the venture conversions at Columbia, Janine Clough, who published it in JAF. Took her a year and a half in the library, extracting the ventures that convert. Meaning, at that time, you had to get the paper report, go to the paper report, find the venture, extract it by hand. And there were computers already, so she punched cards and ran it. A very laborious process. So the last thing you wanted is collect too much data. Or you would only collect data. And what actually created is dissertation that are data collection rich and analytic poor. Because by the time you collected your data, you are done with your 2 or 3 years working on this. And what happens today, if you see what researchers do, they run thousands of regressions until they find what they want to find. Now, some people say this is cheating, and I say no, it's not cheating if you do it right. I always thought Professor Kogan, when I talked about this, would have a fit. He actually agreed with me. He said, yeah, that's the way people do it now. And that's what you should do. Of course, what I tell to you guys is don't overfit. Don't create a model out of your exploratory data analysis and test the same model. Exclude some data, do some other way to validate that you are really checking the model. But by doing that, what you can do is focus on the assertions of the audit. And not just the classic assertion, but a much more detailed hypothesis testing. And decide what are the things that you can, that the data is telling you that are worthwhile exploring more in detail. And actually Trevor and Chi are kind of trying to do a little piece of work to convince the ICPA that the standard should be changed to force exploratory data analysis. So let's see what's happening. But this is actually the pieces or where visualization can help. And let me just say a couple of things. And we are struggling with this. This is not easy because the AICPA folks, the radar folks are suspicious of the whole idea. Because hey, we do graphics, so why do we have to do a research project? But let me say three things, maybe two things, that you really can do scanning the data visually. The first thing is multi-period analysis. Okay, if you look at, for example, I'm going to show you this. Look at Abdullah's dissertation. He actually shows, this is New Jersey Medicare reimbursements, Medicare, Medicaid reimbursements. And what he shows is things like people died 2 times, same hospitals, different hospitals charged for the same tests at the same time. They show a lot of things just by comparing 1 year after year after year. There is this guy called Hans Rosling, and he's a very famous demographer, population study, and he makes these talks in TED. TED are these computer talks, analytic talks, and he developed a software called Gapminder, I think Gapfinder, and basically what he shows is things like population growth, number of children, wealth, and he just kind of has a number, has a graph of a year, and then goes the next year, next year, next year, and it just moves beautifully. Very, very interesting, and it shows that you visually cannot see these effects. The other thing is you can't visually see 3-dimensional or 4-dimensional effects, and that's good enough. These two things basically prove that the visual scanning of numbers doesn't tell you the story. The third thing I usually say is that graphs are very good to extract after the model is impounded. For example, you have insurance reimbursements or insurance fees, and it's a straight line. Size of the insuree, how much you charge. Should be a straight line. And so you can fit a regression and see what goes away from regression. However, if you take the slope and the value of the regression out of it, you have the residuals much clearer to observe. So there are three things where you just expunge the model, you do the visualization dynamic, or you do multiple dimension graphics that visually you cannot, your mind cannot do it by simple number scanning. So that's strong enough argument on visualization, and we are trying to do it. Okay, I ran out of time, so let's see what else I have here. I don't think anything else is. So we have some visualizations that we showed here, and then we talk about our educational program. There is one thing I want to talk to you, but I think Ahmed is going to do one chapter of his dissertation about this, and I'll come back to that. And I call it TPR, Technological Process Retrofitting. And I'm going to give you examples, etc. But the generic idea is that a new technology comes up. You have to change your process, and then you discover that you can apply it to things of the audit or to things of any process into different areas. So I had some examples here, which is scanning an OCR, etc., etc. I'm going to leave this to talk next time. What I'm going to ask is Andrea or Kirsten, or I'll do it, is I'm going to send you an email probably tomorrow with what article you're supposed to review for next class. Okay, I have everyone's email, and I'm going to ask each one to review one article, but But I want you to read all the articles. But you should be the expert on one, and you should be the discussant of the others. Each one is going to be, I'm not going to ask you to come up and discuss them, but you prepare some slides explaining the article, and then everyone can discuss. Okay, and I'm going to randomly choose who presents first, and if we run out of time, we run out of time. Next time we do a different topic. We are not going to drag until we finish. Okay, and this, one thing particularly for you guys, this will be, just do all the readings on this class is good enough for your PhD exam, part of auditing. The other parts I cannot say anything, but for auditing never has been the major problem because you guys come very prepared. Okay, and I'm going to ask your forgiveness, but I will, over the 14 weeks we have, change the topics a little bit, depending on what's happening. I get interested in an article, I find a certain article. I just this morning found an article in Accounting Horizons. Just got the Accounting Horizons, found an article that I really wish I had included. So guess what? I'm going to include it. And I'm going to take something out. Also, I think, don't you think my articles are a little bit old? Yeah. So I think I want to kind of make it. You know, there are some things like Kinney's work, etc. I really have to have it in there. But I think I'm going to eliminate some and move some things around. Also, I discovered a whole new set of articles that I like a lot. So I'm going to do that. Okay, thank you.